Good evening, everybody. Dr. Barry Burns is probably one of the best trainers of investing that you're going to come across. So with that, Barry, take it away. We're anxious to see what you have for us tonight.
Well, thank you, Steve. I appreciate that. And Jim and Becky and everybody at Candlestick Trading Forum, thank you for your patience. And everybody who's here, we got a big crowd here today. I want to thank you all for your patience, too, and apologize for that. Yeah, the technology gods, I don't know, they were not in our favor today because this is really good stuff you're going to learn today. And I guess the hedge funds and the institutions don't want you to learn this. So they hacked into Omnovia to try to thwart this. But God came to our aid and said, nope, we got to share good things with good people. So anyway, that's my story, and I'm sticking to it. All right. So it's actually not a real long presentation today, but it is a really good one. And I say it's really good not to be egotistical at all, but just because this is stuff that's really helped me in my own personal trading. So what I'm sharing with you is stuff that I use. It's not just theory, it's practical, and I use this in my own trading. So I know that it's very, very helpful. That's my ugly mug there. I'm not going to give a long bio about me since we're running so late, but again, I am Barry Burns with TopDogTrading.com. I'm the owner and founder. I wrote the book Trend Trading for Dummies, part of the famous Dummies series of books published by Wiley & Sons. I'm sure you're familiar with that series. I've received numerous Reader's Choice Awards from Technical Analysis of Stocks and Commodities magazine over the years. I've contributed to other authors' books, worked with big major companies. Again, I'll just float through here like a butterfly and not going to mention them too much. If you're interested in some more free stuff from me, I do have a podcast. Feel free to go to iTunes, Google Play, Stitcher, wherever podcasts are, we're pretty much there. And this is a service that I provide to the trading community for free. There's no advertising on it or anything. I've been approached to sell ads, and I've said no because, well, I just want it to be a good contribution to the community, so feel free to check it out. Of course, we got to make our lawyers happy, because if our lawyers aren't happy, then ain't nobody going to be happy. It's going to be a bad day for all of us. So, again, I'm not going to read every word here, but I do want to really encourage you to read this. You know, we all have these regulatory statements on our sites. Whoops. And for good reason. Don't think of this stuff as just legalese. What it really is where your education should begin and continue. Because if you really think about it, why are we required to put these regulatory statements out here? It's because a lot of people do get hurt trading, and that is just the very, very transparent truth. And so the regulators have sifted through all the data and all the reports, and they've said, okay, here are the ways that people are getting hurt, and we're going to disclose that to everybody and require that you all do that as well. So that's what we're doing. So this is part of your education, and it's a very, very important part of your education. This is the defense part of your game, how to avoid losing money. So I'd encourage you to go to Steve's site or my site or wherever and read through these disclaimers and the longer forms as well. Okay, so today we're talking about how to trade markets that are about to make big moves. One of the hallmarks of professional traders is that we get in before amateurs, and I'm not using amateurs in a way at all. I was an amateur. We all started out as amateurs. It just means someone who's not making money yet, and we all start there. So nothing wrong with that. That's just the way it is, part of our journey. But one of the things that I've learned in my journey is that trading is psychologically very challenging. You know, as human beings, we have a natural desire for certainty. And it's natural as part of being human. And it's not bad. But trading is very counterintuitive to human nature. In fact, years ago I wrote an article called Good Trading Must Feel Unnatural. And part of that is because we all, as human beings, have we're social beings. So we have a herd instinct. And then when you think about certainty, it kind of would make sense that, well, gosh, when everything lines up and everything looks good and everything's certain and confirmed, well, that's when I should take the trade. And that is not true. That's one of the little challenges of trading, is because it does make sense. It sounds logical, but here's what actually happens. Because markets are auction places, you are dealing with masses of people. And remember, as I just said, most people lose money. So if you become like most people, in other words, follow your herd instinct, you will be on the wrong side of the trade most of the time. You'll become part of the 80% of the 80-20 rule, Pareto's principle. So by the time everything's confirmed, guess what? Everybody's seeing it. By the time everything's obvious, everything lines up, everything's beautiful, the counterintuitive thing is that, yeah, mathematically you would think you got all the ideal situation. The problem is, from a mass psychology point of view, everybody and his parakeet sees it now, and they're jumping on it, and the masses are losing money. So we as professional traders, we want to get in before that. And this is not a new concept, by the way. This goes all the way back to Dow theory, which talks about, well, he used the term discounting the market. And more popular term that you might have heard of is the phrase, buy the rumor, sell the news. By the time it's news, in other words, by the time it's known, it's too late for a trader. So we like to get into these big moves. All of that is a preface and talking about the reasons why we get in before the big moves, because we want to get in when our risk is low and our reward is high, and before the average person is comfortable taking the trade. All right? So, just like all things in life, successful trading is a lot like anything successful in life. You got to get outside your comfort zone. So, today we talk about volatility. Volatility, I haven't changed the slide here, so if you're wondering, nope, it's still the same slide. I'm just getting verbose here. When I refer to volatility, the general idea is the price range of the market in a given period of time. So here, I don't know if you all can you guys see my cursor? Kind of afraid to play around with drawing tools or anything here. So I drew these red boxes, as you can see. And because these boxes can kind of give you that image. All right, so again, volatility is the price range. So price is over here, your y-axis, over a given period of time, the bottom axis. So when you cover a wide range of price in a short period of time, that is the general idea of a high volatility market. When we cover a low range of price over a large period of time, then that is a low volatility. So that's kind of the bird's eye view. That's the big picture of it, okay? Just to give you the concept. Cursor's not moving. Oh, okay. Well, all right. We can still see the images there. So what are some patterns that we can trade using this concept? In other words, there's a cycle. There's many different types of cycles in the markets, by the way. You've got your kind of sine wave cycles, your highs and your lows. You've got your seasonal cycles throughout the calendar year with the retail sector, the agricultural sector, things like that. Many different types of cycles. But the type of cycle we're going to talk about today is volatility cycles. So some patterns that we can trade using volatility cycles that are pretty darn well known would be your Bollinger Band squeezes, for example, contracting channels, wedges, similar, triangles, and moving average convergences. So we're not going to talk about all these today, but what I am going to focus is on moving average convergences, because I don't hear too many people talk about these anymore for some reason. And then we're going to talk about triangles, primarily because I love triangles. Back in the days of yore, when I was the head moderator of a futures trading room for about 3.5 years for, well, I don't think they're even around anymore, but for a big company. And they hired me to come in and to moderate the open and the close every day. And I was kind of known as the triangle guy. I was trading triangles all the time. And for some reason, I saw them when other people didn't. So I love triangles. I'm going to share with you how I trade them differently than most people today. And then detachment from equilibrium. And none of these are brand new concepts, by the way, but I'm going to show you how I trade them. Okay, so those are the three we're going to focus on. All right, so let's focus on pattern numero uno. Eins. Ichi, Japanese. See, I'm trilingual with the number one. Uno. Did I say uno? Yeah. So I've got Spanish, German, and Japanese down there. Pretty good. So the moving average convergence is very simply this. Now, you can use different moving averages if you want to. There's no magic moving averages for that. But what you do want to do is you want to have some moving averages that are spread out a bit. In other words, you want to have some that are real short-term and some that are real long-term. That's the only real requirement. So there's the 4 that I use. I put them up there for you to see. So I use the 15 EMA, the 50 SMA, the 100 SMA, and the 200 SMA, as you can see. So as you can see where the black rectangle is, all 4 of those moving averages have clustered together. So that's what we call a moving average convergence. And mathematically, what that basically means is that over the last, now this could be on any time interval. A lot of times people ask me, well, what time interval? Obviously you can see this is a 3-minute, but this same pattern could be used on daily charts, 60-minute charts, tick charts, whatever. So this one is kind of time frame agnostic, if you will. And I don't mean that in a religious sense. I just mean it doesn't matter. It will be relative to whatever time frame you're trading it on. All right, and also any market, stocks, futures, forex. Again, so this is because it's just pure moving averages. So what it's literally measuring and telling you when you get this structure, this is what I would call a structure, a chart structure, is that over the last 15 bars, 50 bars, 100 bars, 200 bars, there's really been no significant change in price. Right? It's all right around the same zone. So between the last 15 bars and the last 200 bars, there's been a sum net total of a lot of nothing. Okay? Now there'll be swings and all that stuff in between, but it's all accumulated into really nothing. So there's no, and how we would transfer that into market psychology, not individual psychology, but the mass psychology of the market, is that there's no strong sentiment right now, bullish or bearish. Market's basically kind of neutral. All right? So what do we do with this? Well, we identify that and we say, okay, we have a low volatility cycle right now. So the market right now is in a low volatility period, cycle, period, time, all interchangeable. And what do? We're going to look for a time for the market to then go into a high volatility cycle. Because markets cycle between low volatility and high volatility. This is one of the most powerful cycles that I ever learned, and it's just phenomenal. Again, reward to risk ratio is what's so great about these. So now you have a couple of opportunities. Like many things in trading, you can be more aggressive or more conservative in your entries. So right in the middle, right there about 1045 or so on the chart, if you wanted to be real aggressive, you could try to take that. Obviously, we've got where wave 3 is there. By the way, these are not Elliott waves. I don't personally trade Elliott waves. These are my own. This is my own formula for wave counting that I came up with myself. I call them berry waves, for lack of a better term. Why not? So, wave 3, that obviously puts in a high there. We got a failed 5, comes down here. So if you wanted to be real conservative, you could enter here. Or if you wanted to be more conservative, you could trade the breakout above the high of the failed 5 there. So you've got several different opportunities. Any of these you'd actually be pretty darn okay with, right? And the market takes off. And that's the point, is we go from a narrow range market to a high volatility market. And it just, boom, takes off like a rocket. Those are the fun markets to be in, the ones that take off. It's fun to see your P&L go up fast. All right, so this is the structure to look for, and then how you choose to enter, that can vary. You can use some indicators or candlestick patterns, whatever. I mean, here we've got just an amazing green bar, and that's where really the power, the bullish power takes off, is right on that green bar that's right above number 4. Okay, that's where, boom, the big energy comes in. Okay, so that is number 1. Number 2. Pattern number 2, numero dos, zwei, duo. That's actually Korean, not French. French is deux. So I'm so multilingual with numbers. Pattern 2 is triangles. Now, triangles are very popular, very well known. I trade them differently than most people. So I want to give you this insight into how I trade them and see if you're comfortable with it. With all this stuff, by the way, I should always preface, say, test everything first, simulate, test it, demo test it. Never trade this stuff with real money out of the gate. In fact, test it over a large sample of data, not only to prove I know this stuff works for me, but part of trading is finding out what resonates with your brain cells, right? And some of this will, some of it won't, and that's cool. Take what works and flush what doesn't. Okay, so I take a very aggressive approach to triangles. So as you can see, we've got a lower high from the F5 to the F5 that connects the blue line at the top. And then we've got the lower blue line going on the higher lows on the bottom. So that forms our symmetrical triangle. Okay, now there are basically three ways that I've seen people enter these. Number one is right on the breakout of the bottom trend line. So that would be your breakout trading approach. Has some advantages and disadvantages. The second one is what's called the throwback. It's technically not called a retrace because it's not in a trend. Technically, it's called a throwback. And that would be where you would trade either at letters B or D there below the blue trend line. Now, some people like to trade that because of what you see happen here. If you trade the breakout of the trend line right at the breakout, sometimes the market starts, going back up. It has a throwback. That's a 50-period simple moving average line on there, by the way, so that's where it found some support. And we get an ABCD complex retrace pattern. So some people don't like to trade the breakouts because you sometimes get these retraces afterwards, and they don't like to deal with the psychological heat that they have to suffer on the retraces, because during the B and the D waves, they're seeing red on their P&L, and that's not too comfortable. So then they say, okay, well, I'll wait for the throwback, and they'll enter a B or D to go short, and that's cool, but what's the drawdown there? The disadvantage of that is that sometimes the market does not retrace. Sometimes it does just break that lower trend line and just go straight down like the falling knife. And in that case, they just miss the trade. They don't get an opportunity to enter. So again, pluses and minuses to everything. You got to decide, all right, which fits me better? Am I okay with missing out, right? FOMO, fear of missing out. Am I okay with dealing with that sometimes because I'll get better entries and not have to stand the heat? Or am I okay when the market retraces a little bit and I see my P&L go a little red, and that's the heat I have to suffer? Yeah, just like to say, beauty is pain. Well, trading is pain too sometimes. So there's no one answer that's going to solve all your problems. Sorry. And, that's part of the business, and that's part of what makes trading challenging, and why most people don't make money is because they want everything to be too picture perfect. And unfortunately, the market's not that nice and neat and tidy and clean, and it's not going to move to the exact pixel on your screen that you want it to move to. So now there's a third way. I don't trade either one of those. Well, sometimes I will. But my goal on every triangle trade is actually to trade what I call inside the triangle. And you see it there in the yellow box, trading inside the triangle. And you see the plum. I'm going to try to use real metrosexual color references here instead of just man cave references, which would be purple. But no, that's a plum arrow. My wife would be proud of me right now. And so I'm trading inside the triangle. Remember I said professionals get in before amateurs. This is why you get sometimes all this noise, this A, B, C, D stuff, and why you got to suffer through that. Because why? Because now everybody sees the triangle's broken. Everybody in his parakeet, as I said before. I used to have a parakeet named Champ. Even Champ knew about that. And so I'm like, okay, if that's what everybody sees, I want to get in before that. So how do you do that? Well, you trade the lower high inside the triangle. So that looks a little more risky because people say, well, gosh, how do you know that's where the final high is going to be? How do you know that's going to be a lower high in order to form a triangle? And those are all excellent questions. And that's why most people don't do it. And you've got to have a way of determining that, yeah, there's a high probability that that will be a lower high, that will be the final high. The way I do it, I don't have time to go into it now, but I'll give you the answer with some freebies I'm going to give you here at the end. Nothing for sale today, by the way. I actually showed up with nothing to sell you, so I kind of dropped the ball there. But what I do have are some freebies, and I will actually give you access to my timing indicator that I use to nail these highs and nail these lows. And that's why I'm confident trading this. Most people would not be able to do it because the only way you can do that is if you do have a way of just, really accurately, precisely with surgical precision, nailing cycle highs and lows. You've got to have that. Otherwise, the question is very valid. How would we know? And you could use candlestick patterns, right? But you get some candlestick patterns at all different places, so you have to use it in conjunction. In fact, using candlestick patterns with it would actually be great. I like to use a confluence of things along with my candlestick patterns. So I do use candlesticks on every trade I take, by the way, just to be clear about that. But I'm using things in conjunction with it because the way I look at trading is it's a probability game, and there's never any certainties, but I want the most evidence that I can get. Preponderance of the evidence is what I trade by. It's like, and I want those pieces of evidence to be uncorrelated. Very important. I've seen people who have sent me charts with 5 different indicators on them, and they say, "What do you think?" And I'll say, "Well, I appreciate your effort. Very good. You're a good student. But here's the problem. All 3 of your indicators are, let's say, trend indicators." So that's not really very helpful because what you're doing is you're measuring one thing, trend, direction, and you're doing it with 3 different instruments. So that would be the equivalent of putting 3 speedometers on the dashboard of your car. Who would do that? So when you look at it that way, no. So when we put together pieces of evidence, the strategic key to that is making sure that those pieces of evidence are uncorrelated. So I liken this to a legal case. Okay, let's say some guy's on trial, and 3 witnesses go up, and one is his brother, and he says, "No, he didn't do it." And another one is his girlfriend, and she says, "No, he didn't do it." And the third one is his mommy, and she says, "No, he didn't do it." Not so trustworthy, right? Maybe carry a little bit of weight, but not a lot. Why? Because they're all related. They're all related. As opposed to if in that same scenario you had 3 people go up and testify, none of those 3 people knew the accused ahead of time, and none of those 3 accused know each other. They've never met before. And they all 3 say, "Yeah, I'm an eyewitness, and I saw him do it with my own 2 eyes." Okay, that guy's not going to have a very good future. So that's an example of using uncorrelated pieces of evidence. So in trading, that's what I do, and this is where when you do use tools, candlesticks, indicators, moving averages, whatever you're going to use, you've got to understand them intricately so that you understand that they are strategically uncorrelated to each other. By the way, extra little tip here to give you a little extra edge. This triangle also happens to be a head and shoulders pattern. So you see there's another little piece of evidence. Now that is a different piece of evidence. A head and shoulders, a proper head and shoulders is defined as something that creates the end to a trend. So classically a head and shoulders pattern, and I've seen people look at this all different ways, but in my mind, following the classic approach to head and shoulders, it is the end of a trend. And so a higher high and a lower high, like you have here with 3, F5, and F5, that alone is not a head and shoulders. It's only when that comes in the correct context of the entire chart, or what Ellen Farley calls the landscape of the chart. And that context would be at the end of a trend, or after an extended trend would be a more neutral way of saying it. So I only look for head and shoulders after we get a wave 5. Okay, and we've got a failed wave 5 there, therefore it is a head and shoulders, and it's a triangle, and therefore I would expect not only for that triangle to break to the downside, but also for the trend to change for at least a little while, which gives me a good reward, right? By the way, also notice that when you get in at the F5, the second F5 there, your reward to risk ratio is the best. So the risk will probably be about the same, but what's better is the reward because you're shorting at a higher price. So taking these more aggressive entries gets you a better reward and therefore better reward to risk ratio, and it gets you in before all the amateurs come in when it's obvious, and you don't have to suffer through all the noise because after all this noise, you're still in the green. You're still in the green. Okay, pattern 3, the final pattern for today, is what I call detachment from equilibrium. Now, this is specifically a day trading technique. So the other two are universally applicable to pretty much any time frame, any market that you can plot on a chart. This one, no. This one is definitely a day trading technique. So the points of equilibrium we're looking at here are YC and PP. So those stand for yesterday's close and pivot point. So we're using floor trader pivots, as they're often called, and pivot point or central pivot will sometimes be called. Those are synonyms. That is the point of equilibrium based on the floor trader calculation, and which is a very simple mathematical formulation. You can Google it and you can find it. Some trading platforms even have indicators that will automatically draw them for you. And then yesterday's close, well, that is yesterday's close. That's what it is. It's going to be just a rock-solid number. It's not a formula. So professional traders, what we do is we're more interested in the close than the open because the close tells us, again, kind of like with the moving average convergences, after all was said and done the previous day, and the market did all its ups, its downs, its wiggles, its squiggles, its big moves up, and then its reversions to the mean after people had irrational exuberance over, news or, sometimes just over gossip or rumors or a Trump tweet or, whatever. What did the market value, or what did the participants value the market at after all that was said and done? That's your closing price. That's your closing price. So that's what the market participants decided that market, whichever one you're trading, was worth after all was said and done. So yesterday's close, very important coming into a new day. Above yesterday's close, generally people are thinking we're bullish. Below yesterday's close, generally they're thinking, we're bearish compared to the previous day. Now, when you get the pivot point and yesterday's close come together like this very closely, which you don't always, by the way, sometimes they'll be spread a little further apart. So I use that region between the pivot point and yesterday's close to be the neutral territory or equilibrium. So instead of just using one line or the other, I use the two together. Oh, thanks, Dean, for typing in the pivot point calculator. Awesome. So as you can see here now on the next slide, I have highlighted that zone in yellow. So it's that zone that I'm looking at, not just a line, but a zone. And as long as we're in that zone, we're in neutral territory. We're in, the market is balanced, in other words. So that is, again, the equivalent, or the same kind of concept, I should say. Equivalency is not the right word, but it's the same concept of the moving averages binding together. It's the same concept of a market contracting, whether it's triangles, wedges, whatever. And so it's that same concept. Now, so we're looking for a breakout of that equilibrium point. A little extra tip I'm going to throw your way here. You can see this happens to be Disney 2-minute chart. No particular reason for that. Got to throw something up there. If I threw up the euro, somebody would say, hey, how come you didn't put Disney up? Or if I put a 60-minute, someone would say, how come you didn't put a 2-minute chart up? But what I do want you to notice is the red line down here, yesterday's low, YL, at 106. Now, that is yesterday's low. Lots of traders use yesterday's high and low as significant levels. And they definitely are. But what I've noticed recently is that those levels are being gained more than they used to be. So I don't see as often anymore the market just breaking through yesterday's low and going down, 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 down to the center of the earth, or breaking yesterday's high and then just going up to the seventh heaven. What I see more often these days is what you see here. Market breaks down below yesterday's low, and then it comes back up above it. And then it breaks down below it again, around 7:15, and then by 7:45, it comes back above it again. Why is that? Same thing we've talked about. Because everybody and his parakeet, or gerbil, whatever the case may be, guinea pig if you will, they are looking at those levels. And that's the challenge, right? That's the challenge. Now, there's certain advantages to seeing. You want to see what everyone else sees. You definitely want to see that. It's a matter of how do you trade it. So don't expect just because your higher low is closed that, the market's going to take off and we're going to have a bullish day or a bearish day after that. You look at that, you evaluate it, but you got to watch the market bar by bar, because the market can do anything at any time. The market is more like a wild Bengal tiger than it is a purse puppy. And if you think the market is out to get you, you are right. And I'm not kidding. That is not a joke. If you ever felt like, gosh, the market hates me, the market's out to get me, it's not so much that the market hates you. It's nothing emotional. It's just that when you take a trade, there's somebody on the other side of your trade. And they're not trying to make you money. They're trying to make themselves money. So in that sense, yeah, the market is kind of against you and against me because they're trying to take our money and put it in their account. So don't be surprised. That's the natural dynamic of an auction place, which is kind of the way I see the whole market based on, I don't really use market profile too much, but I do adhere to the market profile philosophy of how markets function. So what I do is I prefer to actually, I don't like to trade again, it's kind of like the triangle trade, right? I don't like to trade the breakout of yesterday's high or low for the very reason. I like to wait for the market to come into the equilibrium zone and trade the breakout of that. And when it did that, boom, finally we're golden. So getting in earlier, again, than most people. And there's the big picture. That's the whole day at, one fell swoop. So once we finally did go back into equilibrium, then we shut down, and then we stayed below yesterday's low. But that was after 1, 2, the third break was the one. That was the charm. All right. Well, so I gave you 3 patterns to trade today. All right. We're just finishing up here. Now, one of the questions that comes up is which direction to trade when you've got these contracting markets. Here's what I do. There's a very clear answer to that. I don't just trade in the direction of the breakout because, again, we get a lot of false breakouts. So what I use is I use the energy of momentum on the higher time intervals. So this is where multiple time frames come in. So on the next higher time frame, I'm looking at the energy of momentum, and momentum is strength. Think of what is momentum. Well, momentum literally is velocity times mass. I'm a pretty literal, concrete kind of guy. So velocity in the market is the speed of the orders. Mass equates to volume. Again, there's 2 types of volume. Looking at the volume histogram on the bottom of your chart, great thing to do. Should you do it? Yep, you sure should. But if you want to get to the next level of sophistication, you need to divide that volume into professional volume and retail volume. Because who do you think is going to rule the roost? Yeah, it's the professional volume, because that's the smart money. So not all volume is created equal. So we look at momentum on the next higher time frame, and that's the direction we look for the break out of these consolidation patterns. And then how to get in early? Well, I use personally my market timing indicator, which I'll make available to you for free. So here's the final slide. And I got nothing to sell, so I just got a bunch of freebies for you here today. And I'm going to give you really a multi-part freebie package today I'm giving you guys. So one thing I'm going to do is give you one of my trade strategies that I use. I trade this setup every single time it sets up. So this is, I'm not just giving you a little has-been, I'm giving you a trade I currently trade every time I see it. Because, and one of the reasons, by the way, I give it away is because it has a very, very high win-loss ratio. And I find that until people start becoming consistently profitable traders, The win-loss ratio seems to be more important to them, to build up their confidence, more important than the reward-to-risk ratio, by the way. So this is a low scalp trade, does not have a big reward-to-risk ratio, but the win-loss ratio is just stellar. And that's why I like people to start with this one, give it away for free, prove it to yourself. Again, no investment for you other than, just going through these 5 short videos, and I'll teach you that trade. Again, please demo test it, simulate test it, make it, prove it to yourself, get used to it, get the feel for it before you ever start trading with real money, if you ever decide to trade with real money. So this little package has 5 videos, little interactive quizzes at each one as feedback loops to make sure that you understood them. And then for that cycle indicator I mentioned, I present that on a free webinar because that's way beyond what that takes a whole webinar into itself. The indicator, just to be very transparent, it's nothing you have to download or import. What we do is we modify a very common indicator that's on every trading platform out there. And I like to do it that way because that way, no matter what charting software you're using, you can use this. We don't have to program it for 20 different charting platforms with all their different programming languages. So it's pretty simple, but we do have to modify the indicator because it's not actually a cycle indicator by its nature. So we make some modifications. I show you how to do that. We get it set up on your charts on this second free webinar. And then I show you how to trade it. In other words, the reason I give the tutorial on a webinar is because if I just gave you the parameters, it's not intuitive how to trade it. The triggers, this is my surgical tool, by the way. This is the one that I use to get me into the penny, to the pip, or to the tick. And, literally, it's a rule-based system. To the penny, pip, or tick, I know where I'm getting in, and I know where to place my stops. I'll show you that as well. Keep my losses very small. The range of my risk on any trade is usually the range of 1 candlestick bar. That's it. So that's how risk averse I am. And I can do it because of this indicator. So, and you can use this with any, again, this is just one part of a trading method. So if you're trading, any method, you could use this and just add it on as your trading trigger if you like it. And I'm pretty sure you will because it's really turned around my trading. And I always give away my best stuff. I don't know why I do that. Anyway, so, yes, any questions before we close up here? I want to thank you guys. Most of you have stayed, even though we got started really late. Daniel asked, does it work for futures? It sure does. Absolutely. Absolutely. Works for futures, stocks, Forex. And, I trade anything, any time frame, Eric, day trading, swing trading, time-based bars, tick bars. Yep. I even have students who use it with like Renko bars and things like that. So the only thing that I would say is that, well, I'll just be descriptive instead of prescriptive. I have not traded this with cryptocurrencies. I haven't traded it with binary options. I do trade it with regular options, but I've never traded binary options. I've never traded cryptos, so I can't attest to those from personal experience. I don't trade penny stocks, so I can't attest to that from personal experience. I personally like to trade markets that have professional involvement because my whole philosophy of trading that undergirds everything I do is what I call my hook your wagon to the whales approach. So what we're doing, like I said, there's 2 types of volumes. I'm sniffing out the professional volume, looking for block trades and the big institutional orders, and I want to get in right along with them. I know I can't beat them, so if you can't beat them, join them. I don't have as much money as they do, or the power, the intellectual power, the computer power, or any of that stuff. They got that. So great. They're the smart money. So I'm not going to argue with them. I'm not going to fight against them. So they're the whales. So I just take my money, I put it into my little red wagon, and I tie one end of the rope to the handle of my red wagon, the other to the tail of the whale, and I just let them go and take my money with them. That's my whole philosophy. So that's why I trade markets with that professional involvement. Okay? All righty. Jim says the link is working. Good. Awesome. All right, last good. You got it. Awesome. All right. Any last logins? You guys have been pretty quiet here, I'll have to say. So, yeah, I'm not used to such quietness. Still, most people are here, though, so that's a good sign. All right. So, good question, David. How do we get the indicator from the link? So the link, what that will do is that'll take you to a page where you just fill out the form and you'll start getting the videos. There's 5 videos, as you see, and you get a video every day for the next 5 days. You can watch them anytime you want, right? But they're dripped on you over the next 5 days. And then you'll also get an invitation to the next webinar. And that will be live as well. So I'm with you live so that I can answer your questions, walk you through it, explain everything in detail. And let's see, when is our next free one? The next free one is Saturday. Yeah, the next cycle indicator webinar is Saturday. And then we also have another one next Tuesday. So we've got Saturday morning and Tuesday evening-ish, actually right at the same time on next Tuesday. So for different days, different times, weekends, weekdays, to make sure that it fits everybody's schedule. Yep. Lee asks if I'm using the built-in pivot points or customizing mine. I don't customize them. I just use the classic pivots. Yep. Yeah, they're built in. I use the ones that are built in. Good question. Yeah, there are different types of pivots out there that you can use. And I can't tell you if some are better than others. I just stick with the standard ones because that's how I was taught. And they keep working for me. So as long as they keep working, don't mess with success. Absolutely. All right, well, I'm going to stop it there, and I want to thank all of you for being here and for being patient through our technical challenges. Thank you so much for that, and again, I apologize for that, but we did our best, and at least we finally got this thing going, so I hope you received value out of it, and I especially want to thank every single person here for taking your precious time, the most precious commodity you have, and sharing it with us. I hope it was very much worth your while. I love to give value to traders. And of course, I especially want to thank the host today, Candlestick Trading Forum. Stephen, I love you, brother. You are amazing. Anything that Stephen puts out is excellent, so always follow his stuff. I do. And Jim and Becky and everybody else at Candlestick Trading Forum, thank you very much for your assistance and hanging in there with me to resolve the technical issues today.